Then what's it looking like this week?
Well, markets are consolidating, Abha. I mean, that's very clear for the last few days. It's not going up too much, it's not going down too much either. I mean, you saw last week towards the end, we did make a dart towards the below 16,000 level on the Nifty once again, but it did not hold there. But again, there was buying at that level and the markets bounced back, conveying the impression that it's not quite done yet, maybe with the pullback that started around 15,200. So we went up to around 16,200 kind of levels, had a 300-point kind of a pullback, and now we've come back to those kind of levels again. So I think the best word to describe this is consolidation. It's a kind of a trendless market at this point in time. As we discussed last time, it appears that the market might have exhausted the weakness for the moment, because it was a one-way kind of a fall on that way, all that way down to that 15,000 level, and having come back from there, I think the market's just about treading water. There is some sense of hope once again in the market, and has been some buying at lower levels as well. And now I guess we'll just wait through the earnings season and see how it goes. I mean, the first couple of earnings have not been great, but they've not been disastrous either. I mean, from the big names like TCS or HDFC Bank, they've been par for the course with minor downgrades kicking in, particularly for TCS. So we'll see as the earnings season progresses further whether there is room for the market to go back to below 16,000 levels, or it's possible that we can hang around here for a few weeks and then wait for the global cues to determine whether there is more downside from here. But for now, I don't think there is anything special which has happened over the last few days to warrant a kind of a trend call for this market. I think we're just about consolidating.
The markets have been in volatile territory for some time now. Will this fall continue as central banks continue to hike interest rates? We spoke to Andrew Holland, CEO of Avendus Capital, on the effect of the central bank's actions globally and particularly on economies in the US and India.
It's been a bad market for nearly a year now. But where are we now in this bear market, you think? I mean, it's been pretty orderly so far as these things go. But do you see the prospect of things getting uglier as we get deeper into the year?
Well, first of all, Udayan and Abha, it's a pleasure always, and takes me back to our old times. But so it's a pleasure for me. Thank you. Could it get uglier, Udayan? The answer is probably yes, and I think the reason behind that is that we're still into that tightening mode, for the central banks globally. And, we don't know what the unintended consequences of that might be. You've had liquidity, you could have streaming around for the last few years since COVID. So there could be some, things that have been hidden under the carpet, which we don't like once liquidity starts to dry up. And, if you look back at what happened in China, where they tightened in 2021, the outcome of that was obviously this big problem now in the property market. So maybe there's some unintended consequences. Maybe some of it's played out already, say in the crypto world, where we've seen obviously some big defaults there. But I'm still worried about the credit markets as the Fed reduces its balance sheet. And let's not just concentrate too much on the Fed. There's also Europe, which is really spiraling down into a recession. And if Mario Draghi does resign in Italy, then that will have other consequences for the bond markets in Europe. But the big thing, the big message from Europe is that the powerhouse Germany is not the powerhouse anymore. So if that's faltering, the rest of Europe is probably going to feel a lot more kind of downward swift from that. So that's the problem. And again, whilst we talk about central banks increasing rates, it's going to be different for each country. For the US, really inflation is a lot of it's in the housing market. So they really have to bring down the aggregate demand in housing. Say in India, ours is more food inflation. So we have to look at food inflation and energy inflation. Same for Europe. So I think every central bank will have its different approach to this, which will bring its own volatility and downward risks.